Most hurricanes destroy homes, some destroy entire towns, but this one destroyed something far bigger. It bankrupted an insurance company that thought it was untouchable. This is the story of the storm that broke the system. For years, American Reliance Insurance Company built its reputation on one promise: affordable coverage for everyone. They were small but ambitious. They expanded into coastal Florida markets where bigger insurers refused to go. Why? Because the risk was too high. But American Reliance saw opportunity. They offered low premiums, fast approvals, coverage that seemed too good to be true, and behind the scenes it was. American Reliance took on thousands of high-risk homes across South Florida without building the cash reserves needed to protect them. They were one major disaster away from collapse, and that disaster was already forming. In mid-August 1992, meteorologists noticed a tropical disturbance off the coast of Africa. At first, it looked harmless, a cluster of thunderstorms drifting west across the Atlantic, but within 24 hours, the system exploded. Warm Gulf Stream waters, low wind shear, perfect atmospheric conditions. It intensified faster than anyone expected. Tropical storm, Category 1, Category 2, and then, almost overnight, a Category 5 monster named Andrew. This was not just another hurricane, it was a worst-case scenario. When Hurricane Andrew made landfall on August 24, 1992, it struck with terrifying precision. The eye passed directly over American Reliance's most concentrated region, a stretch of South Florida coastline filled with older homes, weak roofs, and building codes that had not kept pace with modern storm science. In less than 6 hours, entire neighborhoods were underwater. Roofs peeled away like paper, cars floated down streets that had turned into rivers, power grids collapsed across Miami-Dade County, and the calls for help began. Within 3 days, American Reliance received over 18,000 claims. Roof damage, flooded homes, destroyed vehicles, entire properties wiped off the map. The company had prepared for a bad storm, but not for this. Not for hundreds of millions in losses. Hurricane Andrew caused over $15.5 billion in total insured losses across the entire industry. For a small regional insurer like American Reliance, even a fraction of that was catastrophic. Insurance companies do not survive disasters by luck. They survive because they buy reinsurance, insurance for insurance companies. But American Reliance had a problem. To keep premiums low and stay competitive in the coastal market, they cut corners. They bought the bare minimum reinsurance required by law, and they gambled that a catastrophic storm would not hit. They lost that gamble. As claims skyrocketed, American Reliance ran out of money. They could not pay homeowners. They could not pay contractors. They could not even pay their own employees. Regulators from the Florida Department of Insurance stepped in. Auditors opened the books, and what they found was worse than expected. American Reliance was insolvent, completely bankrupt. The company was placed into receivership within weeks of the storm, one of 11 insurance companies that became insolvent in the wake of Hurricane Andrew. Thousands of families were left stranded, their homes destroyed, their savings drained, and the insurance checks they were promised never came. Some took out loans to rebuild, others walked away from their homes entirely. Many spent years fighting in court to recover what they were owed. For the families of South Florida, the storm never really ended. When one insurer collapses, the damage spreads. In the years following Hurricane Andrew, dozens of insurance companies raised premiums dramatically or pulled out of the Florida market entirely. New policies became harder to get and far more expensive. Property insurance costs in Florida nearly doubled within 5 years of the storm. A single hurricane reshaped the entire insurance market, and homeowners are still paying the price today. American Reliance did not fail because of a storm. They failed because they were not prepared for one. Insurance only works when companies plan for the worst, because sooner or later, the worst always comes. But this was not the only disaster that exposed cracks in the system. In the years that followed, new storms and new financial crises would test the industry again. And what happened next was even stranger.